Live from New York City and London, England, David Balin, Stephen Whiting with this week's The Point. We are in the 13th day of the Iran war, and the title of our presentation today is You Can't Unbomb, but You Can Recover. And the reason we're talking about that is that the war has had unusual and profound impacts on certain parts of the market that we're going to discuss today, and that has created an enormous degree of uncertainty and heightened volatility. But underneath it, we're still dealing with issues associated with the labor supply, with AI, with software, things like that. And what we're going to talk a lot about what's happening below the market. But in order to do that, we have to understand what's happened with oil and the impact on the world economy. So during the first day after the war, we saw a 42% swing in prices that Stephen's going to talk about for oil. That gives you a sense of the fact that outcomes are highly uncertain. That is not typical, but what happens when you only have a limited global supply of oil and the inability to deliver it where it needs to go. So one of the reasons that we're looking at an unusual situation is that the world is awash in oil. It's not as if we don't have it. The question is how it gets to where it needs to go and what the impact of the broadening war in Iran actually means for the global economy. Not since 1974 have we seen a situation just like this. We'll talk about the impacts, historical impacts, and their relevance to what we're going through right now. And most importantly, put it in the context of the 21 previous global historical events that actually give us an indication of what is likely to occur when this is over in terms of recovery. And then we're going to look through all of this to look at the opportunities that have been created in a couple of areas of the market, ones that we're actually going to add to in our portfolio development. But let's go to the next slide, Stephen, and talk a little bit about what's going on right now. What are your observations?
So again, it's most important to think about this very differently from periods when we had insufficient oil supply. You can take a look at 2008 like that, when the U.S. had record low production for a multi-decade period, or 1974, when all of the countries that are now being hit by drones in the Middle East purposely shut down their production and said we would not export oil. Instead, what we had was a really high level of oil output throughout the world, but suddenly an insecurity of the ability to ship it. So wells are being shut down because there's just no place near the well to store that oil. It's a very, very different situation, and it can be really remediated with secure shipping through the Persian Gulf or oil pipelines across Saudi Arabia as one option for a little portion of that oil. I think we want to stay, most importantly, with our assumption that the oil price will again plummet if and when they can secure shipping in through the Straits of Hormuz and the Persian Gulf. And one other assumption, that the oil production facilities, not in Iran, but outside Iran, throughout the Middle East, that none of those production facilities are horribly hit. So what you could see from other things, we've had really correlated sell-off for about a week. 70% of sectors were down together for a full week, something that's happened only 8 times in the last 20 years. But we'll talk about the fact that, this morning, the S&P is down less than 3% from an all-time high, which is unusual for a period when we've had a shock. We are seeing 2 areas unrelated to the oil issue, which are really showing some distress. Software, which has dropped more than 20%, and that was about AI concerns. They haven't gone away. There are concerns about software as an industry in terms of credit. So private credit and private equity managers have dropped, believe it or not, 44% from their high. So lots of other areas that you'd think would have trouble, like airlines and cruise ships and hotels, those are holding up even better. So we want to be careful to say we can get past this crisis when we have secure shipping again. The real opportunities are not going to be in those things that are normally hit when there's an oil crisis, like airlines.
Yep, pretty remarkable, the performance of the S&P as a result of what's happened. So let's look ahead to some of the data that sort of gives us this. So you could take a look at the fact that historically, crude oil prices have overshot early in crises because, of course, those are the periods of the greatest uncertainty. No one knows exactly the length of time this war will take, and no one knew that Iran was going to actually strike against most of the Middle East countries as a part of their retaliation strategy. So when you take a look at the ultimate peak in historical world oil prices, that happened twice, right? Once at $145, right, in 2008, right, when the U.S. production actually was at its all-time low. And then again, you could see later at the invasion of Ukraine by Russia in February of 2022, when oil prices peaked at nearly $130 a barrel. So, Stephen, do we expect that we've seen peak oil prices already, or is that just a conjecture?
Well, it is a little conjecture, but if we were to secure transportation through the Straits of Hormuz, if that happened today, I would imagine that that high that we reached on Monday in the oil price is the high, and you will not see a higher price if we were able to freely transport oil out of the Persian Gulf. That's my condition.
That's right. Next slide, please.
Maybe I should take this picture on the right just to show you, like why is it that the oil price is moving so remarkably when the actual production losses have not been that significant? Well, you could just see that picture illustrated on the left. I put a range of, tenfold on there, but the oil price moves 15 times more than oil output. We said this a couple weeks ago, but I think you can illustrate it pretty nicely on the right. Now, there is a coordinated release of strategic reserves by governments around the world. We'll know exactly how much it is out of the United States. But the point is that strategic reserves are even smaller than commercial inventories. And if oil production were to stop everywhere in the world, if the U.S. were to go to zero in oil output, how fast would we consume our oil? You can see in the U.S. case, it'd be about 20 days. All of those commercial inventories would be completely gone. So you think about the oil industry as sort of a just-in-time industry. We're constantly producing, consuming, and refilling those storage areas all the time. That's why small disruptions in the shipping and in storage have a very big effect on price because it's entirely consumed. It's pretty amazing. The U.S. economy alone consumes 7.5 billion barrels of oil per year. If you think about that, it's going up in the atmosphere. It's going very, very quick. And so it constantly needs to be produced. On the next page, just two other points here. We made the observation earlier that there is no shortage of production. This is not 1974. You can see that dip. But what you see is all-time high prior to this war. But what the issue is on the right is very much like the pandemic period. That we're not going to be as bad as we were in the pandemic. At that point, we had massive swings in demand related to the pandemic, stimulus, and ports were blocked. They were constrained and clogged up everywhere in the world for every consumer good in the world. This is, again, more regional. It's more centered on petroleum and gas. There are, of course, other commodities that are being affected, like fertilizers. But this is a shipping shock. That's the global supply chain pressure index from the New York Fed on the right. It doesn't yet reflect these conditions. But you're going to see a problem with shipping. Not so much necessarily unless there is a terrible, terrible conflict that harms the production and the facilities throughout the Middle East. This is really about the inability to move the oil. And that's another reason why we believe it'll be redirected. And eventually, if the U.S. were to able to reestablish some safety for shipping through the Persian Gulf, the oil price would be plunging because we're really oversupplied in many respects.
Great. Thank you, Stephen. So let's go to the next slide. So what we've seen, of course, is an extraordinary increase in volatility. So the VIX, right, the measure of volatility in the market, reached 36 in both the first Gulf War and in Ukraine. It has not done so, at this moment in time. And as Stephen said, what's really interesting is that the markets all responded negatively. In this rare moment when 70% of the sectors, right, were negative for 5 days, has only occurred, as Stephen mentioned, 8 times in the last, was it, Stephen, 40 years, I think, right?
20 years in this particular.
20 years in this case. But what's really interesting is that the market is only off 3% from its top. So the way we look at this is that people are expecting the war to resolve and expecting a continuation of growth and are expecting that, and you'll see this on the next slide, that industrials, part of the market, the core parts of the market, are continue to be profitable. But historically, what's really important to understand is that only twice, right, in World War II and in 1974 during the OPEC oil embargo, did we see that what happened in oil, right, changed the direction of the world economy. And Stephen, is that largely because of the fact that, ultimately it wasn't about energy?
Well, I think the issues here is that these shocks are not really economic shocks. They're not booms and busts. When you build more housing than you could possibly need in the US or China, you've got a real problem. When you've overinvested in useless capital spending and you've got to plunge production, you've got a problem. When you have a disruption, it's different. And most of these, again, we've been living with regional conflicts. There are multiple conflict zones in the war, as President Trump will remind everyone. And that is the point, is that growth and conflict really coexist. Now, there can be a situation, 1974, as we mentioned, in the same region where we didn't have sufficient oil. We literally ran out of gas. We had insufficient energy supply to power the economy. That would happen if this conflict were to stop oil from the Middle East over a really prolonged period of time. It's not going to happen again if it turns out that we can reestablish some safety of transport in the Middle East. And I would again think that we're much more likely to confirm to more than the 90% of cases where this will be regionally devastating. Look at the country of Lebanon. But it is not going to be that way for the whole economy once oil is being moved again.
That's right. Now, and this is why we talk about having reactive portfolios, people who manage money and believe they need to get out of the way or take action right away when crises occur, are just not aware of the fact that this is the historical backdrop for that. And again, looking at the data and looking beyond, right, what's going on right now is important in developing what the future portfolio should look like.
That
So let's
top
look at
line
the
just
next slide.
showed you the average, the average reaction after 30 days after any of these shocks, including some horrendous conflicts around the world. The average is that the drop in equity markets is erased in 30 days. Again, because simply it is not usually something that's catalyzing an economic decline. So it's typical to get back on course.
Yep. Okay, so we'll move ahead. And the issue then is what happens afterwards, right? And what we really want to talk about is that the two big issues, one is going to have to be what is going to happen with the job market. And the Fed is going to have to take a look at a very serious decline in terms of what looks like labor demand at the moment. We're seeing a really a slump in employment, forward-looking data at the moment. And of course, that plus what was announced with AI and the ability for it to potentially dislocate different parts of the economy, the labor economy in particular, and all that was written about that, which was just 4 weeks ago, Stephen. It's hard to believe, right, how the news has sort of changed, the scope of the news. But that is what is going to be front and center, right? It's the question of what we saw happen in February with really small increases in demand for labor. So, Fed, what do you think that the Fed will do, right? Assuming that the war is resolved at some point soon, what do you think the Fed's actions might look like? Because
You know,
expectations are that they're going to do nothing.
this is yet another difficult one because the person that's been nominated to be the next Fed chairman, and we'll see whether that can be done before May or not, is someone who believes that inflation's highly monetary. So if there's a supply problem, you should manage to tamp it down, right, and keep prices stable with tight monetary policy. And that's the way that he's talked about this in the past. And that would argue for at least holding policy steady and saying, okay, inflation's up, we can't do anything about the economy, which is true. But when inflation is temporary, you should be able to do something. And we were able to see the Greenspan Fed ease monetary policy during the Gulf War of 1991, even though inflation had temporarily moved up. There was a notion that inflation expectations had been stabilized at that time and that we weren't going to cause any lasting damage by giving the economy some help. I think that that's the case again, but it's still one where the recent memory, the mistakes that the Federal Reserve made in 2020 to 21, when we allowed double-digit money growth for a couple of years and 9% inflation. Now, of course, this happened in the backdrop of the pandemic. Wars and pandemics have been inflationary. They curtail effective potential of the economy to get goods and services where they're needed. But this is one of those times, again, where it's a little difficult. But the job market is a little bit unambiguous here. Now I know January and February we had distortions, 130,000, negative 92. Which one is it? That was January, February. We'll skip over what happens with the seasonal adjustment process, which we've illustrated on the left. What you see on the right is the public is saying that the unemployment rate is rising. You can see that in the Conference Board survey. You can see that in the black line in the official unemployment rate. We told you that January, when the unemployment rate dropped, it's not what's really going on. So there is more supply of labor than there is demand for labor. And that's with all the people saying that, hey, we're aging, we have low immigration, this should be good enough. The reality is at 25 or 30,000, what we had in the first 2 months of the year for employment growth is insufficient. The Federal Reserve, once we're through some inflation worries, should be moving on to an easier monetary policy to help the labor market to stay out of the way, again, of the labor market. So there are all these
And I think,
issues.
right,
Sorry.
and there are, listen, and there's no doubt, right, that the impact that AI will have is in front of us. It is absolutely an extraordinary tool for productivity, and that you can see in other data that we're not going to be talking about today. But it does mean that demand for labor, right, for everyone from college age labor to folks that are materially older, is going to actually have an impact on the necessity of adding more labor in the marketplace. And at the same time, and we've talked about this before as well, the economy itself, profitability within corporations is going up. And part of that is actually the efficiency and the productivity that we're seeing in the economy in general that's allowing that to occur and allowing the market to go higher. And these contradictory impacts are something that the Fed has faced before, but nothing as profound, I think, as AI is going to be. And if you haven't had a chance to read the piece that Steve and I issued over the course of last weekend called Your First Industrial Revolution, I suggest you actually go back and have a look at that. So
Yeah, I was going to
let's
suggest, David,
move ahead.
the piece that you did that really just showed a redistribution to capital income from labor, from AI, is something that's largely ahead of us. These are issues to deal with. Whether AI is disruptive for particular companies, sure, that's going to be an issue we have to deal with. Trade uncertainty. The U.S. administration, while it's waging a war in the Persian Gulf, is also trying to replace its trade authority to put tariffs on. So all of these are things that we face all at once. And many of these issues haven't disappeared, even though we're so focused in on the safety and security of American troops and civilians around the Middle East.
That's right.
So
So on the left-hand
here,
side,
please.
sorry, I was going to say a highly unusual two circumstances, Stephen, and these are, as part of our investment philosophy, we ask ourselves every time we see a major dislocation, what is the significance of this, right? And on the left, I know you're going to talk about this. We see a huge difference, right, in the performance, right, of the S&P versus software, and we've talked for years about the fact that software and hardware technology, of course, is the driver of growth, but at the moment, right, been hugely discounted. On the right-hand side, we've seen a 44% drop from the peak in the price of private equity companies. We've all been reading about private credit and the difficulties, right, in some of the private credit portfolios and people wanting to get out of private credit funds and the lockups that have taken place in some of those funds, those evergreen products. But the fact is that those private equity shares, right, over the last 5.5 years have performed to this point after the 44% drop, right, as well as the S&P. So you can see how volatile they've been and how much beta that they have. But we as a firm, Stephen, right, we talk about the idea that each time you see a dislocation, you have to take a look at whether that's an opportunity or something to be fearful of.
No, that's right. And certainly in the case of software, we know there are some software firms that are going to become obsolete. There always have been. But when the entire sector, when the entire industry has so deeply underperformed the S&P 500, when it's at the lowest level since the year 2000 compared to hardware, there's something going on here. And we'll show you in a couple of slides, what it looks like. Why is cybersecurity and defense two areas that work so well together that happen to be driven by some of the very same factors? They've got a 75% difference in return. So we do want to buy software, knowing that, again, some of the companies will be replaced, but not all of them. As an industry, it's been replaced. The picture on the right is interesting because these are the best performing large private equity and credit firms. And for people who want to believe in allocations to private assets, Well, you can think about their returns, and we'll show you another slide on that shortly. But if you just think about the opposite side of this on the next page, when we think, well, why don't we want to just buy the whole equity market and just switch out of bonds and to go into more equities because these drops in the market related to insecurity and conflict, they're really temporary. Well, but take a look at how mild the response has been. Industrial companies, and defense is a small slice of this, but many cyclical industrial companies have dropped 3-4% only after that great performance. So if you believe that the economy could be hurt, this is an area where it's normally expressed, industrials. Even more clear, airlines, lousy long-term returns. Look at that blue line, which just shows that they never really compound any
Never make
growth.
money.
Yeah,
Right.
this is a reason why we don't like them for the long term, only if they were as depressed as 2020. Then you'd want to buy them. Well, look, they haven't shown much impact yet. Resorts, hotels, cruise lines, all of this discretionary travel has had a really small drop compared to the scope of the risk right now. So there are different opportunities. They happen to be unrelated to the war, but these are areas that just show there's been little impact.
And you'll see that in the next slide, to me, one of the most remarkable opportunities in the market in a subsector on the left-hand side. This war has already had an enormous set of activities associated with cyber activity, right out of Iran. By the way, also out of Russia and China is what I'm reading now, that there's a lot more activity that's taking place. And yet cybersecurity shares as a group, and which are part of software, right, are actually lagging enormously relative to hardware. And you can see that on the left. And that to us is a type of place where we want to have a specific allocation to that subsector, right? Because just like defense contractors, there's not going to be in the world of AI a need for less cybersecurity, but rather more. And on the right-hand side, you can see why diversification is extraordinarily important. You wouldn't believe it, but that blue line over there are what is the index of master limited partnerships associated, right, including energy, relative to the performance of the NASDAQ. Now, we have both of these in our portfolio, recently added to the energy MLP sector. But our point is that you have to have different return streams in an economy like this in order to have a safer portfolio. The whole idea that a total return of an energy index could be like what we've seen in technology is kind of remarkable. It's something that we've been paying attention to for quite some time, and now we've added it to our portfolio, increased our exposure to it. So the critical thing for us is when we see dislocations, we want to be buyers of those that actually are meaningful. But in all of what you've seen across this presentation today, if you had taken your money out of the market, if you were scared a year ago in April when there was a whole talk of of Trump's tariffs destroying the global economy, or if you had done so at the beginning of this war, or if you had done so at the time that AI was going to take over the world, and destroy all labor this year, or DeepSeek a year and change ago, the fact of the matter is that responding to the news in that way ignores what is essential to be a great investor, which is what is the global market doing in terms of profitability, in terms of the allocation of those profits to labor and to stocks, right, to the actual security, and whether or not we think that that's continuity. And the global economy is remarkably resilient, regardless of what happens in global politics, which is a remarkable fact, but as an investor, something that we think is extraordinarily important, and why you hire people like us to actually remind you of that as you watch an incredible set of news grow across your television or your iPods. There we go. So earphones. So there you have it.
David, I'm just going to make one more remark on the MLPs as an example. Again, we think that this is something that is not quite as sensitive to the rise and fall that we expect in oil prices. We added before the issue came with the strike on Iran. And so again, we've advised generally not reactive types of allocations to this, given the history, but think about those things that where there have been dislocations that are really not related, to the war in Iran. And this picture again of defense and cybersecurity areas that we've both been overweight for most of the last year, the return potential now looks better for cybersecurity given how it's lagged. And that brings to the last slide. And if you take a look at the next page, we noted before that private equity and credit managers, some of this has been software concern driving this. That these are areas that are high beta. These are not necessarily the secular growth industries that we always want to overweight, but a lot of investors are looking for alternatives. There are good reasons for it in some cases. It's access to the most incredible, innovative companies in venture investing. And that's something that David and team have had on our presentations before. In some other cases, it's just to get parts of the economy that are not public. There's a vast share of borrowing, lending, and equity that is just not public yet. We understand that. But very often you end up with poor returns, opacity, and illiquidity. And we've been bringing up the idea that you could invest in the public equities of the companies that are at the forefront of those returns. Look at the largest fives. If you take a look over a decade-long performance, it's outperformed the S&P 500 by 5 percentage points. The products that the private equity and credit industry, we're taking a look at private equity returns on the right. If you include the fact that there's cash on the sideline that's not fully invested, we come up a return that's well below their common equity.
Yeah, and we'll be writing a lot more about this, because if you were to add up the employment that the companies owned by the top 6 or 7 private equity firms actually control, they're going to see the revolution of AI have a positive impact on them, which is the ability for them to generate greater profits that go, as we talked, to the value of companies. And they're going to have to deal with the disruption associated with AI in their industries and their respective businesses. But the fact of the matter is that they are, right, even after this 44% drop, they've equaled the S&P performance. And now we're doing the analysis to determine, and I think we're leading this way, to actually talk about the fact that buying them, right, is to buy a swath of the economy where they're going to have to manage through the inclusion of AI into these business models. And I think there's going to be a positive benefit to these companies in the fact that they are going to employ fewer people, generate greater profits, and ultimately that will be reflected in the stocks of these private equity firms rather than in their private investments, which suffer from illiquidity and which I think deserves its own substantial premium. So, Stephen, thank you very much. I hope you have a great rest of your trip in London. You can contact us, right? Either at db@ciogroup.com or sw@ciogroup.com. Or if you want to speak to info@ciogroup.com, even our info will write you back, because we've created an incredible bot to do that. So thanks so much for joining in today. We'll see you soon.
Thank you.